Here we are. Today we are meeting with Mark Tamburo of Get a Better Mortgage, a mortgage broker that we have been working with for close to 20 years now. And the reason we decided to sit down with Mark today is that because there were so many changes implemented recently by the government to the mortgage rules that I think it is important for the general public to understand exactly what's happening. And what we're faced with in the general market in Toronto in real estate is rapid growth of average prices. In the month of December 2016, the average price in Toronto grew by 24%, and then the year 2016 compared to the year 2015, the average price grew by 17%. So the price growth is accelerating actually, where in the last 15 years we saw an average growth of 5, 6, 7, 8% or so. So definitely it has been a concern to different levels of government. And as an example, the BC government recently introduced a very unpopular law which imposes 15% tax on foreign investors. Right now they're actually backpedaling, trying to change that to offer some incentives to bring those investors back. The municipal governments, whether for that reason or other reasons, for example in Toronto they have introduced land transfer tax, which again is very unpopular, and now they are thinking of doubling this tax because the city needs funding. Because they did not get the road tolls, now they have no choice but to look for funding in property tax increases and also in perhaps doubling the land transfer tax, which would again impact the real estate market here. But anyway, so all of that, and this is just on the provincial and municipal side. We're hoping that the Ontario government will not implement any taxes that will penalize foreign investors. But in the meantime, the federal government has implemented a lot of changes which are very directly affecting the real estate market and the purchasing power of the especially first-time buyers. So what we would like to explain to our viewers is basically what changes happened. There were changes that happened in October as well as November of last year, and there's another set of changes due to be implemented in March of this year. So perhaps we can start by explaining what exactly changes took place in October and November of last year.
Okay, Paul, thank you. So the government has made several successive changes to the mortgage lending rules beginning back in 2010. There were successive changes that were intended to control borrowing, to control real estate price growth, and also to, I think, to try and enforce responsible borrowing. So the most recent changes that we're speaking about in October were changes that impacted predominantly insured borrowers. So when we talk about insured borrowers or insured home buyers, it impacted the amount of money that they could qualify to borrow. So previously, when we were qualifying people for a mortgage, insured, when we refer to insured home buyers, we're talking about purchasers putting less than 20% down. If you're putting more, 20% down or more, the mortgage is called a conventional mortgage. But on an insured, or what we call a high ratio mortgage, those people always had to qualify, or more recently had to qualify using a 25-year amortization. But previous to that, if our client took a 5-year term fixed mortgage or longer, we got to qualify them using the contract rate. So if someone had a discounted rate from a lender at 2.5%, for example, that was the rate that we used to get to plug in the ratios to determine the size of the mortgage that they could qualify for. The changes to the legislative changes said that now we have to qualify at what the bank calls, or the government calls, a benchmark rate. So the benchmark rate is an average of the 5 major banks' posted rates, and that number today is 4.64. So the net result of plugging 4.64% in that formula versus a much lower rate. So today, an insured borrower could get a mortgage at somewhere around 2.59. So you're talking about a 2% increase in interest rate qualification. That would
huge,
enormous. So that would reduce the amount of money that someone could borrow by virtue of that formula of roughly 20%.
So what can you give us an example, like on let's say $800,000 mortgage or $1 million mortgage, how much the purchasing power has actually decreased for an average?
A better example would be, so for example, I had a client recently that I did a pre-approval for prior to the rule changes. So we did a pre-approval for her in September. Her income was roughly $75,000. So at $75,000, even though she had a conventional down payment, she was going to be good to buy to roughly $450,000 with 10% down. So she'd have roughly a $400,000 mortgage, and she qualified for that. After, I think the number was more like $380,000. But regardless, after the legislative changes, now having to plug in 4.64 in that same formula, her borrowing power reduced it by 20% down to $310,000, $315,000.
Wow.
So she went from being able to find something and purchase something that she liked, that she could afford. Mm-hmm. Now she's looking at a price point that she can't find anything. There's nothing in the GTA market.
So it's almost 20-25% basically decrease in purchasing power.
In purchasing power,
yeah,
borrowing capacity.
I think in the newspapers we saw something quoted from someone who used to qualify for $800,000 and qualified only for $600,000. So their purchasing power went down $200,000. Right. And in the meantime, the price is going up by 20%. So you know, not only they cannot catch up with the market, but they can afford less and less. And what that likely causes is a lot of people being forced to give up their dream home, buying a home and having to buy a condo. Then also people buying with condos having to buy a cheaper, smaller condo. And some people may not be able to find anything at all, and they'll have to just keep renting.
It certainly impacted I don't want to say the lower end of the market, but your millennials, your first-time home buyers, your entry buyer were the ones that were most impacted, because it was the insured buyer that was impacted. People who have what we call a conventional down payment, or 20% or more, and this is the irony of the rules, is if you have 20% down, you are still eligible to get a 30-year amortization for qualification purposes, and we're still able to use the contract rate or the discounted rate. So those people's borrowing capacity have not been impacted.
And when those rules were implemented, were you given any period of time within which, let's say, they could still purchase within 60 or 90 days and still apply the old rules, or they basically, as of that particular date?
They were announced, and we had a couple-week window.
That's it.
And that was it.
And
what was so upsetting to our industry was when previous changes were implemented, there was historically dialogue between all the different stakeholders. So the government would talk to the real estate professionals, they talk to the banks, they talk to the lending industry, they talk to mortgage professionals, they would talk to the mortgage insurers, companies like Genworth or CMHC. They talk to all these parties and they'd say, this is what we're looking to do, how do you think that's going to affect it? And they would tweak it, and they would make changes that ultimately were deemed to be reasonable by all parties concerned. These changes were, unfortunately, not consulted with really anybody, and they were very impactful. And frankly, in many instances, they were unfairly levied, because certain stakeholders and players in the industry were affected by far greater degree than those that were not.
So basically, those were the changes that happened in October and November, and now again, we're now in February of 2017, and we're about to experience another set of changes.
Well, the changes in October and November were twofold. So there were changes that were levied to the borrower, which are the ones that I just explained. The other changes that they made impacted the lending community. So the result of the cumulative changes that happened prior to that date were an insured mortgage by definition. So an insured mortgage or a high ratio mortgage had to be restricted. So what was typical of an insured mortgage is the maximum amortization was 25 years. The property value could not exceed $1 million. It could not be on a rental property, and it could not be used for a refinance. Okay, that was kind of the general benchmark rules. What the government then said was, a lot of lenders who participate in the industry, after the fact, even if a mortgage is conventional, they would book what we say portfolio insure, or they bulk insure thousands of mortgages and put it in a pool. So even if the pool was compiled of conventional mortgages, because they were being insured after the fact, the government said, well, we're going to apply the rules that apply to a high ratio mortgage, even to a conventional mortgage that's in a pool. So now all of a sudden you have a number of lenders who raise capital this way. Now all of a sudden they can no longer do refinances. They can no longer do mortgages at all on properties in excess of $1 million. They can't do rental properties. So the initial response to the marketplace was a bunch of lenders had to completely cease operations until they figured out what was going to happen.
So if you fall into that category, you have fewer choices of lenders.
Correct.
That you can.
Now, the dust has settled. This happened in November. December was kind of a feeling out period. Now, a lot of these institutions have now aligned themselves where they now have funding sources or they have opportunities. But the problem is now you have, we definitely see on our pricing matrices for mortgages that you have tiers depending upon amortization, tiers depending upon the asset type or the product type. We have what we call insured versus uninsured mortgages. So the market's become a lot more fragmented. There's a lot fewer players in certain lending types or certain scenarios.
So basically, so all of those changes happened in October and November of this year.
Correct.
And then now there's like another wave for March?
Yes, the next set of changes are going to impact, and they really are behind the scenes, and it's something the public is not that aware of, but those of us who work in the industry are very much aware of it, and that is the fact that they're changing the capital requirements. So this is the money that institutions have to set aside and mortgage insurers have to set aside on mortgage loans, and also they're changing the premium rates. So without getting too complicated for the general public, when a lender does a mortgage, oftentimes behind the scenes they insure it, and the insurance companies, there's 3 insurance companies in Canada that participate. There's the government, which is CMHC, Canada Mortgage and Housing. There's Genworth, and there's Canada Guarantee. And these 3 companies all perform the same function. They provide mortgage insurance for the consumer when they buy a property and are putting less than 20% down. And they also provide insurance for the lenders when they want to portfolio insure their mortgages. So what they've done is they've changed the premiums that a lot of these companies are being charged on different loan classes. So the difference between 80% versus 75% versus 70% versus 65%, etc., the premiums are different in each case. And many times they're 3 and 4 times as much. So you have huge differences in cost of capital for a relatively small difference in loan to value. You also have different premiums based on geography. You're going to have different premiums based on credit rating. So now, as a mortgage industry, when we go to price a mortgage, your loan amount is going to be a function, or the interest rate is going to be a function of where are you borrowing. In fact, where are you buying a property? And the irony is, they're going to charge a premium on areas that they consider hot. So where's the hot zone?
Because of volatility, or?
Well, if you think about it, if you were going to lend money, or if you had to sell a property, where would you think that it would more likely sell more quickly if you had to load a property? Here versus Northern Ontario?
Oh, for sure, it's here in Toronto.
So you would deem the risk to be lower, correct?
Lower in Toronto, yeah.
They made it the converse. So in Vancouver, in Toronto, in the GTA, in markets that are actually hot, they deem to be of higher risk. So they're going to charge premiums, higher premiums on our market. They're going to charge different premiums on credit ratings. So someone with a 720 credit score versus 780, the risk as a lending community is not very different, but the premiums could be as much as 3 times as high.
Wow.
So come March, we're not really sure what's going to happen.
So basically the major changes happen to all mortgages that are between 20 and 35% down, basically. So your choices will be in fact limited if you're in that kind of category.
The conventional space, so a high ratio mortgage, so if you have someone buying a property, one of your buyers, young couples buying a condo, and they're putting 10% down, they actually have access to the cheapest money by interest rate because they're paying the premium themselves. Your couple who buys that property, they buy a place for $500,000, they put 10% down, they have a mortgage of $450,000, they pay a CMHC premium of roughly 3%. It gets tacked on top of their mortgage. Okay? They're paying that premium. They have access to very cheap money. The irony is now that that same buyer, if you have someone buying who's putting 25 or 30% down, they actually have to pay a higher interest rate than someone putting 5% down or 10% down. So try and explain that. And the reason being is because in the first scenario, the consumer is paying the premium. In the second scenario, there is no premium being paid by the consumer. The lending institution is paying it. So they want to pass on some of that cost to the borrower in the form of a higher rate.
And that applies in that category up to 35%. So if somebody has more than 35%, then it's fine. But up to 35% down.
Well, 20% is that's kind of the magic. Well, 35% is a different measure. 20% is kind of the magic number. So most lenders that aren't balance sheet lenders, they are going to charge a premium for a mortgage at 80%. So the difference in interest rate is going to be anywhere between 15 and 20 basis points.
Gotcha.
So if I'm a mortgage company, what we call a monoline, my rate is going to be 20 basis points higher than will be for an insured mortgage. But for a balance sheet lender like a bank, it won't be. So
basically, traditionally, we've had the three major types of institutions that were offering mortgages were the big banks, the 5 big banks. You had the mortgage companies that only do mortgages, and then you had the credit unions, right? So these were the three largest categories.
Yes.
So out of those three categories, the two of them will be at a disadvantage now, basically.
Credit unions never really competed in that space as aggressively, and they're actually, for now, the credit unions are regulated by a different body. OSFI regulates the banks and indirectly the mortgage companies, but the mortgage companies are at a significant disadvantage now because of how they raise their capital. Balance sheet lenders have an advantage in the short term, which is the big banks for now.
So those lenders will also accept deposits, so they have access to capital.
Correct. We all bank typically at one of the big 5 institutions in this country.
Okay.
We leave our money.
So, but the bottom line is that the consumer's choices will be impacted. The consumer will have fewer choices, or the other companies will find it more difficult to compete.
Absolutely. Yeah. Or this is a classic example, which no one really talks about, is what happens if you have a mortgage with an institution and your mortgage is maturing. So typically your mortgage comes up for renewal, and someone like that would approach me and say, "Mark, can you shop around and get me the best possible rate?" Under the old guidelines, that person may have qualified for a mortgage loan from many different lending institutions, in which case we could shop around and try to get them the best deal. Now, under the new rules, that same borrower may not be even able to move. So imagine if you're the lender and you have a client with a mortgage coming up for renewal and you know that they can't leave. How aggressive are you going to be with your pricing on the offer of your mortgage loan?
That's right.
Right? You're going to offer them, because the consumer's going to have to take pretty much whatever they can get. So this is a new wrinkle, but because it's a new problem, these things are still evolving. But I look down the road and I say, these are the potential pratfalls that the public are going to have to face.
Absolutely.
Anytime you take choice and supply out of a market, it's bad for the consumer, and that's essentially what's happened.
And then the government tried to address this issue of raising prices by only one end. So you always have to consider both supply and demand. It seems like they only address the one side.
They are trying to control the escalating price of real estate, or what they deem to be an overheated housing market, by restricting demand.
Demand, that's right.
And they're trying to restrict demand by making less people qualify to qualify for a particular price point, and thereby decreasing the supply of buyers. But what we're seeing is having very little or no effect.
So basically, and again, one of the reasons perhaps is that they did not consult the parties who were interested in this, like the lenders, like the mortgage brokers, like the real estate industry, and partially this is why those rules are kind of unfair.
When they were announced, needless to say, the major stakeholders in our industry were caught very surprised. There was a shocked and alarmed response to these changes. What was shocking was the depth of the changes. They seemed to be quite severe. I don't have a problem with a stress test for borrowers. I think a stress test for borrowers is a good thing. Essentially what a stress test is it's making sure that if I'm borrowing X amount of dollars today, in the future, if interest rates are a little higher, am I still going to qualify for that same amount of money? We don't want to have a U.S. style housing crisis. Yeah. We don't want to have a bubble. We don't want to have a market collapse. We don't want to have that happen. So I don't have a problem with a stress test. But to apply a stress test with an interest rate premium of 2% above,
that's huge. Yeah.
What's to say in 3 years from now or 5 years from now interest rates are going to be 5%? I don't know if anyone could say that for certain. So it's the severity of these changes. Also the fact that I think the changes impact only certain players in the market and certain players much more significantly. I don't think that's
right. That was the goal of the exercise. Absolutely.
Right.
So we on our pages we have posted many articles that were recently published in various papers. So if you go to facebook.com/Condos and Castles, or you can go to
www.getabettermortgage.com
and get in touch with either myself, Paul Razewski, or Mark Tamburo here if you have any further questions. So thank you so much for your time today, and
thanks, Paul.
Have a great day.
Appreciate it.
Thank you.